Hello, welcome to Capital Sensei. Today we're going to roll up our sleeves and dive into a topic that is the absolute bedrock of intelligent investing. The interpretation of financial statements, but seen through the eyes of the master himself, Benjamin Graham. We'll explore what these documents are, why they are the investor's best friend, and how Graham used them not to predict the future, but to protect himself from it. By understanding the present reality of a business. Whenever we can, we try to answer questions left in the comments. So as we go through this, if any part seems confusing, or if you have a story about your own attempts to analyze a company, please share it below. Your questions and experiences help everyone learn and build a community of smarter investors. So, let's start with the man himself. Who was Benjamin Graham? If you've heard the name Warren Buffett, you've heard of Graham's most famous student. Graham is widely known as the father of value investing. But what does that really mean? It means he was one of the first to formalize the idea that a stock is not just a blinking symbol on a screen. It is a fractional ownership of a real, tangible business. And the only way to know what that business is worth is by studying its numbers. Graham lived through the Roaring '20s, the crash of 1929, and the Great Depression. He saw firsthand what happens when people invest based on hype, emotion, and speculation. He lost a fortune, and then he rebuilt it by developing a disciplined, rational, and frankly, a bit of a skeptical approach. His whole philosophy can be boiled down to one core concept: the margin of safety. We'll come back to that again and again. To Graham, the market was a moody business partner he called Mr. Market. Some days, Mr. Market is euphoric and offers to buy your shares at ridiculously high prices. Other days, he's terrified and offers to sell you his shares for pennies on the dollar. A smart investor doesn't get swept up in Mr. Market's mood swings. Instead, they use his manic depressive nature to their advantage, buying when he's pessimistic and selling when he's euphoric. But how do you know when the price is pessimistic or euphoric? That's where the financial statements come in. They are your anchor to reality. So what are these statements? Think of them as a company's annual medical checkup. They are a set of standardized reports that every publicly traded company is required to release. They tell you in the cold, hard language of numbers about the health of the business. There are three main reports we're going to focus on, what I like to call the big three: the balance sheet, the income statement, and the statement of cash flows. Let's get our hands dirty with the first one, the balance sheet. If the financial statements are a medical checkup, the balance sheet is a photograph. It's a snapshot of the company's financial health on a single day, usually the last day of a quarter or a year. It tells you exactly what the company owns, what it owes, and what is left over for the owners. The balance sheet is governed by a beautifully simple and powerful equation. Assets equals liabilities plus shareholders' equity. Let's break that down. Assets are all the things the company owns that have value. Think cash in the bank, the factories and machinery it uses, the unsold products in its warehouse, and even things like patents. Everything of value is an asset. Liabilities are everything the company owes to other people. This includes loans from banks, bills it needs to pay to its suppliers, and bonds it has issued to investors. In simple terms, liabilities are the company's debts. It's what they owe. And finally, shareholders' equity. This is the most interesting part for us as potential investors. If the company were to sell all of its assets and use that money to pay off all of its liabilities, whatever is left over belongs to the shareholders. That's the equity. It's the owner's claim on the business. So the equation, assets equals liabilities plus equity, must always, always balance. Hence the name, balance sheet. Let's use a simple analogy. Imagine you want to buy a house for $500,000. You put down $100,000 of your own money, and you take out a mortgage for the remaining $400,000. Your personal balance sheet for this transaction would show an asset, the house, worth $500,000. It would show a liability, the mortgage, of $400,000. And your equity, your actual ownership stake, is the $100,000 you put down. $500,000 equals $400,000 plus $100,000. It balances. Now, Graham looked at the balance sheet with a detective's eye. He wasn't just looking at the total numbers. He was digging into the details. He divided assets into two main categories: current assets and non-current assets. Current assets are things that can be converted into cash relatively quickly, usually within a year. This includes cash itself, inventory, and accounts receivable, which is money owed to the company by its customers. Non-current assets, on the other hand, are long-term investments that are not easily converted into cash. This includes property, plant, and equipment, often called PP&E, and intangible assets like brand value or patents. Graham was always a bit wary of putting too much value on these long-term assets, as their true worth can be hard to pin down. He did the same with liabilities, splitting them into current and non-current. Current liabilities are debts that must be paid within 1 year, like bills from suppliers. Non-current liabilities are long-term debts, like a 10-year bank loan or a 30-year bond. This distinction is crucial, and it leads us to one of Graham's most important tests for a healthy company: the current ratio. The current ratio is calculated by taking current assets and dividing them by current liabilities. This simple number tells you if the company has enough short-term resources to pay its short-term bills. Think about it for yourself. If you have $2,000 in your checking account, which is a current asset, and you have $1,000 in credit card bills due this month, which is a current liability, your current ratio is 2 to 1. You're in a good position. Graham, being the conservative investor he was, insisted on a current ratio of at least 2 to 1 for what he called a defensive investor. He wanted to see that a company had twice as many current assets as current liabilities. This provided a significant cushion. It meant that even if the company ran into trouble and, say, half of its inventory became worthless, it could still pay all its bills for the coming year. That's a margin of safety right there in the balance sheet. He took this even further with a concept that is pure vintage Graham. It's called net current asset value, or sometimes net. This is an incredibly stringent test. To calculate it, you take the current assets, the cash, the receivables, the inventory, and you subtract the company's total liabilities, both short-term and long-term. What you're left with is the company's value if it were to be liquidated immediately. You're completely ignoring the long-term assets like factories and brands. You're just asking, if we sold off all the easy-to-sell stuff and paid off every single debt we have, what cash would be left for the shareholders? In Graham's day, especially after the crash, you could sometimes find companies whose stock market valuation was less than this net current asset value. Think about how crazy that is. It's like finding a wallet on the street with $100 in it, and the owner offers to sell you the entire wallet for $60. You'd be buying the cash for 60 cents on the dollar, and you'd get the wallet for free. This was the ultimate margin of safety for Graham, a situation so cheap it was hard to lose money in the long run. These opportunities are rarer today, but they still pop up. Another key balance sheet metric for Graham was debt. He was very suspicious of companies with a lot of debt. He looked at the debt-to-equity ratio. A high ratio meant the company was relying more on borrowed money than on its own capital to finance its operations. This makes a company fragile. A little hiccup in business can become a major crisis if you have huge interest payments to make. Graham preferred companies where equity was significantly larger than debt. Okay, so if the balance sheet is a snapshot, a single photograph, how do we see the company in motion? How do we know if it's actually making any money over time? For that, we turn to the second of our big three, the income statement. The income statement is not a photo, it's a movie. It tells the story of a company's performance over a period of time, like a quarter or a full year. It starts at the top with a number called revenue or sales. This is the top line, and it represents all the money the company brought in from selling its products or services during that period. It's the total cash register ring. But of course, a company doesn't get to keep all that money. It has costs. The first major cost is the cost of goods sold, or COGS. These are the direct costs associated with making the product. If you're a car company, it's the steel, the glass, the tires. If you're a coffee shop, it's the coffee beans, the milk, the sugar, and the paper cups. When you subtract COGS from revenue, you get the gross profit. This tells you how profitable the core product itself is before any other business expenses. But a business has other expenses, right? You have to pay your salespeople, your accountants, the rent for your offices, and spend money on advertising. These are all bundled into a category called Selling, General, and Administrative Expenses, or SG&A. When you subtract these operating expenses from the gross profit, you get a very important number: operating income. Operating income, sometimes called EBIT, which stands for earnings before interest and taxes, is a fantastic measure of a company's core profitability. It shows how much money the business is making from its primary operations before factoring in things like its debt structure or its tax situation. A company with strong and growing operating income usually has a very healthy underlying business. Finally, after the operating income, you subtract the interest paid on debt and the taxes owed to the government. What's left at the very end is the famous bottom line: net income. This is the company's final profit for the period. This is the money that can either be reinvested back into the business to grow it further or paid out to shareholders as dividends. So, how did Graham look at the income statement? First, he was obsessed with stability. He didn't like companies whose earnings were all over the place. A huge profit one year, a huge loss the next. That looked too much like speculation or an unstable business. For a defensive investor, he wanted to see a history of consistent, reliable profitability. He would often look at earnings over the past 7 to 10 years to check for this consistency. He wanted to see a business that was a marathon runner, not a sprinter. Second, he paid close attention to profit margins. He would look at the gross margin, the operating margin, and the net margin as percentages of revenue. A company with high and stable profit margins usually has some kind of durable competitive advantage, what Warren Buffett later termed a moat. It means the company can charge a good price for its product without a competitor easily coming in and undercutting them. And this brings us to one of the most famous valuation metrics of all, one that Graham helped popularize: the price-to-earnings ratio, or PE ratio. The calculation is simple. You take the company's current stock price per share and divide it by its annual earnings per share. What does this number actually tell you? In a very rough sense, it tells you how many years it would take for the company's current earnings to pay you back for the price you paid for the stock. For example, if a stock costs $100 per share and the company earns $10 per share in a year, it has a PE ratio of 10. Graham, ever the conservative, was wary of high PE ratios. A high PE ratio implies that investors are expecting a lot of future growth. That's speculation about the future, which made Graham nervous. For a defensive investor, he suggested not paying more than 15 times the average earnings of the past 3 years. This was another way of building in a margin of safety. By refusing to pay a high price relative to current proven earnings, you are protecting yourself from a future that might not be as rosy as everyone else expects. Now for our third and final statement, which is in some ways the detective of the group. The statement of cash flows. This is a more modern statement than what Graham used, but its spirit is perfectly aligned with his thinking. Why do we need it? Because net income on the income statement can sometimes be misleading. Accounting rules allow companies to recognize revenue before the cash is actually in the bank. They also involve non-cash expenses like depreciation. This means a company can report a healthy profit but actually be running out of cash. As the old saying in business goes, revenue is vanity, profit is sanity, but cash is reality. The statement of cash flows follows the reality. It tracks the actual cash moving in and out of the company's bank accounts. Think of it this way. Your income statement might be like your employment contract, which says you earn $5,000 a month. But your statement of cash flows is like your actual bank statement, showing exactly when that $5,000 paycheck was deposited and what you spent it on. One is a promise, the other is the hard reality. The statement of cash flows is broken down into 3 sections. First is cash from operating activities. This is the cash generated by the company's main day-to-day business. For a healthy company, this number should be positive and ideally similar to or even higher than the net income. This is the cash lifeblood of the business. Second is cash from investing activities. This shows cash spent on or received from long-term investments. This is usually negative for a growing company because it's spending cash to buy new factories or upgrade equipment. If this number is suddenly very positive, it might be a red flag that the company is selling off its core assets to stay afloat. Third is cash from financing activities. This tracks cash coming from or going to the owners and lenders. This includes cash received from issuing new stock or taking on more debt, and cash spent on paying back debt or paying dividends to shareholders. While Graham didn't have this exact statement, he was obsessed with the underlying principle. He would meticulously analyze changes in a company's working capital, the difference between current assets and current liabilities, to understand its true cash position. For a modern investor, looking at the statement of cash flows is a vital cross-check. It confirms whether the profits reported on the income statement are turning into real cash. If a company consistently reports high profits but has negative cash from operations, something is very wrong. So now we have these 3 powerful tools: the balance sheet snapshot, the income statement movie, and the cash flow detective report. How do we put it all together? The Graham way? The key is that you don't use them in isolation. You use them to build a holistic picture, to tell a story about the business. You start with the income statement to see if the company has a long history of stable, decent profits. You don't want a one-hit wonder. Then you turn to the balance sheet. Does the company have a strong financial foundation? Is its current ratio at least 2 to 1? Is its debt manageable compared to its equity? You're looking for strength and resilience. Then, you use the cash flow statement to verify everything. Are those reported earnings real? Is the company generating actual cash from its business, or is it playing accounting games? Only when a company passes these rigorous, historically focused tests do you even begin to think about the price. And when you do think about price, you demand that margin of safety. You use a conservative metric like a low price-to-earnings ratio, Or you try to buy the company for a price well below its tangible book value. Or in a best-case scenario, below its net current asset value. Let's use a final, powerful analogy for the margin of safety. Imagine you need to build a bridge that can support a 10-ton truck. Do you build the bridge to have a maximum capacity of exactly 10 tons? Of course not. A small error in your calculations, a slightly heavier truck, or some unexpected wear and tear could lead to a catastrophe. A sensible engineer would build that bridge to support 15 or even 20 tons. That extra capacity, that 5 or 10-ton buffer, is the margin of safety. That is precisely what Graham was doing with financial statements. He was calculating the load-bearing capacity of a business, its intrinsic value based on its assets and earnings power. Then, he would look at the load being placed on it, the market price, and he would refuse to buy unless the price was significantly below his calculated value. That gap was his protection against errors in his own judgment, unforeseen business problems, and the wild emotional swings of Mr. Market. It's important to understand that Graham divided investors into two camps: the defensive and the enterprising. The defensive investor, he argued, should stick to a very simple, mechanical set of criteria. Large, prominent companies, a long history of continuous dividend payments, a cap on the PE ratio, a strong current ratio, and manageable debt. It's a formula designed to avoid big mistakes and achieve adequate, not spectacular, results. The enterprising investor was someone willing to do more homework. They might hunt for those net bargains or analyze companies in complex situations. But even for this more active investor, the fundamental principles were the same. Conduct a thorough investigation based on the financial statements, and always demand a margin of safety. Learning to read financial statements is not about finding a magic formula to get rich quick. It's about learning the language of business. It empowers you to stop gambling and start investing. It allows you to make your own informed decisions rather than relying on tips from so-called experts or the emotional currents of the market. It takes practice, there's no doubt about that. The first time you open a company's annual report, it can look like an intimidating wall of numbers and jargon. But by starting with the big picture, assets equal liabilities plus equity, revenue minus expenses equals profit, and using Graham's simple, powerful ratios as your guide, you can begin to make sense of it all. You can start to separate the strong, resilient businesses from the fragile, speculative ones. At the end of the day, Benjamin Graham's approach is a philosophy of intellectual humility. It acknowledges that the future is unknowable and often disappointing. Therefore, the only rational path for an investor is to ground themselves in the verifiable facts of the present and the past, as revealed in the financial statements, and to pay a price that so dramatically undervalues the business that a lot has to go wrong for you to lose money. It's not about being a genius. It's about being disciplined, patient, and prudent. And in the world of investing, that is the surest path to long-term success.